$14 billion. That is how much Toyota just committed to North American production. And the most important part of that investment momentum is no longer centered in the United States. At the same time, the most decorated automotive manufacturing plant on Earth is now in Cambridge, Ontario, outperforming every facility in America, Japan, and beyond. More quality awards, fewer defects, higher consistency, no drama. And this is where the story turns from celebration to crisis. Because while Washington was busy selling tariffs as a weapon and shouting about bringing jobs home, the real manufacturing war was being decided quietly on factory floors, in training systems, and inside long-term investment decisions. And the United States just lost leverage without realizing it. This was supposed to be impossible. Integration was meant to reinforce American dominance, not expose its weaknesses. Canada was meant to participate, not outshine, and yet here we are. So ask the uncomfortable question policymakers are avoiding. How did Trump's aggression backfire so badly that the U.S. is now watching manufacturing excellence migrate north without a single factory closing announcement? Because once you understand why this happened, you will realize this is not a one-off embarrassment. It is the quiet collapse of a 50-year assumption and the beginning of a much larger economic reckoning. To understand why this moment matters, you have to strip away the headlines and look at the mechanics of the North American auto system. Autos are not just finished vehicles. They are one of the most complex, tightly coupled supply chains on the planet, built around just-in-time logistics, precision tolerances, and zero margin for error coordination across borders. A modern vehicle contains 30,000-plus parts, sourced from hundreds of suppliers, often crossing the U.S.-Canada border 5 to 7 times before final assembly. Any disruption, tariffs, regulatory uncertainty, labor instability, does not just raise costs, it destroys reliability, and reliability is everything in automotive manufacturing. This is where the data becomes uncomfortable for Washington. Canadian auto plants operate inside the same trade framework, use the same global suppliers, and sell into the same consumer markets. Yet, they consistently deliver lower defect rates, fewer recalls, and higher first-time quality scores. That is not luck, that is system design. Consider energy alone. Ontario's auto corridor runs on a grid that's roughly 90% non-fossil, dominated by nuclear and hydro. That means stable electricity pricing, lower volatility, and predictable operating costs, a massive advantage when margins are tight and uptime matters. Compare that to U.S. plants exposed to regional price spikes, grid congestion, and political fights over energy infrastructure. Now add labor economics. Canadian plants invest heavily in multi-year training pipelines, not churn. Workers are treated as assets, not disposable inputs. That matters because just-in-time manufacturing collapses when experience walks out the door. Every mistake compounds downstream. Every quality failure ripples through the system. This is where Trump-era thinking failed at a basic economic level. Tariffs raise input costs. Uncertainty delays capital spending. Aggressive rhetoric destabilizes supplier contracts, and none of that fixes the underlying issue. Quality is not coerced, it is cultivated. In a JIT system, marginal improvements in execution beat marginal cost cuts every time. Canada understood that. Washington did not. And once you see the system clearly, another truth becomes unavoidable. The problem was never trade. The problem was how production was valued. That is the reality policymakers now have to confront, whether they admit it publicly or not. This is where Trump's strategy didn't just fail, it backfired directly onto American workers, American suppliers, and American communities. Tariffs were sold as leverage. In reality, they functioned as a self-inflicted supply chain tax. Steel, aluminum, electronics, specialty components. Once tariffs hit, costs surged immediately. But automakers could not simply pass those costs on without risking demand, so they did what corporations always do under pressure. They cut elsewhere. That meant delayed wage growth, reduced training budgets, postponed maintenance, and accelerated automation in U.S. plants. Quality suffered. Downtime increased. Recalls followed. You can see the damage geographically. In Michigan and Ohio, Tier 2 and Tier 3 suppliers, already operating on razor-thin margins, were hit hardest. Several supplier associations warned that tariff volatility made long-term contracts effectively unpriceable. One Midwest auto supplier executive put it bluntly, "We can't invest in a 5-year tooling cycle when policy changes every 6 months." In New York and Maine, logistics and port-adjacent manufacturing faced higher input costs without any compensating stability. In Florida, where vehicle imports and distribution hubs dominate, uncertainty translated into delayed expansion and hiring freezes. Meanwhile, Canadian plants quietly absorbed market share inside the same integrated system, not because they were cheaper, but because they were predictable. This is the betrayal Washington never acknowledged. Workers were told tariffs would protect them. Instead, those tariffs undermined the very conditions that sustain high-quality manufacturing. When quality declines, capital does not stay loyal out of patriotism. It moves. And that is exactly what happened. Toyota did not announce a dramatic exit from the United States. There were no angry press conferences, no threats, just a slow, rational reallocation of attention, awards, and future planning toward the places that delivered consistent results. For American workers, the consequences are not abstract. Lower quality scores mean fewer future model allocations. Fewer allocations mean fewer shifts. Fewer shifts mean unstable incomes. It is a quiet, downward spiral, masked by political noise. Trade groups tried to warn policymakers. Automotive associations repeatedly emphasized that supply chain trust matters more than pressure, but those warnings were ignored in favor of short-term political theater. And here's the cruel irony. The very integration Trump tried to weaponize made the backfire worse, because when one part of the system destabilizes itself, the most stable nodes become more valuable. Canada became that node. This is what economic war looks like when it turns inward. No explosions, no headlines, just irrelevance creeping in one investment decision at a time. While Washington was escalating rhetoric, Canada was executing strategy. No speeches, no threats, no press theatrics, just infrastructure, alignment, and quiet repositioning. First, logistics. Canada has spent the last decade upgrading rail corridors, port capacity, and intermodal hubs that directly serve advanced manufacturing. The Port of Montreal, Vancouver, and Prince Rupert are no longer peripheral gateways. They are strategic export arteries connecting North American production to Europe and Asia without passing through U.S. bottlenecks. Rail investments linking Ontario's manufacturing belt to Atlantic ports shortened export timelines and reduced exposure to U.S. policy volatility. Second, trade diversification. While the U.S. leaned into bilateral pressure tactics, Canada deepened redundant market access. The EU-Canada Comprehensive Economic and Trade Agreement, CETA, quietly removed friction for high-value manufactured goods. At the same time, Canada strengthened auto-grade materials and component flows with Mexico, creating a triangular resilience that reduced dependence on any single political actor. This is the part Washington underestimated. Canada planned for decoupling without announcing it. Third, industrial policy discipline. Canada did not chase headlines with reshoring slogans. It tied public support to long-term commitments, workforce training, and local supply integration. Automakers understood the signal immediately. If you invest here, you get stability. If you perform here, you get continuity. That is catnip for capital. And then there is labor governance. Canada maintained cooperative labor frameworks that reduced strike risk and preserved institutional knowledge. In an era where even a 2-week shutdown can cost hundreds of millions, that reliability is strategic power. This is why the phrase, "Canada doesn't need the U.S. anymore," is no longer provocative. It is structural. Canada still trades with the U.S., but it no longer depends on American goodwill to anchor its manufacturing future. That distinction matters. Mexico noticed. The EU noticed. Global automakers noticed. And once alternative pathways exist, leverage evaporates. You cannot threaten exclusion when the exit doors are already open and well lit. This is the counter-strategy Washington failed to anticipate. Not retaliation, but optionality. Not confrontation, but irreversibility. Canada did not win by fighting the United States. Canada won by making itself indispensable to the system and therefore impossible to bully. That is what real power looks like in modern economics. Here is the long-term damage Washington still refuses to name. Trust, once broken, does not reset with elections. Automakers, suppliers, and sovereign partners do not plan on 4-year cycles. They plan on decades. And what the Trump era introduced to North American economics was not just tariffs, it was unpredictability, policy by impulse, strategy by threat, stability treated as optional. That changes behavior permanently. Even if Trump leaves office tomorrow, the memory remains. Boards now model U.S. political risk as a structural variable, not a temporary anomaly. Investment committees ask a new question: what happens if this volatility returns? And when that question exists, capital demands redundancy. Canada benefits directly from this recalibration. So does Mexico, so does the European Union, and beyond them, Russia and China quietly gain leverage as Western supply chains fragment and hedge against American policy whiplash. Not because they are more trusted, but because fragmentation weakens the coherence of U.S.-led systems. This is how influence erodes without a single treaty being torn up. The U.S. once anchored global manufacturing alliances because it was predictable. That predictability justified scale. Scale justified dominance. Break the first link and the rest follows. What Canada demonstrated is devastating to American industrial mythology. Size without reliability is no longer an advantage. Performance beats posture. Execution beats intimidation. And here is the most uncomfortable truth. This shift is irreversible. Once companies build alternative logistics, certify new suppliers, and train new workforces, they do not roll that back just because rhetoric softens. The sunk costs are real. The lessons are learned. Washington can still compete, but only by changing how it values labor, investment, and time, not by shouting louder. The world has already adjusted. The question is whether U.S. policymakers will, or whether they will continue fighting yesterday's war while tomorrow's economy consolidates elsewhere. Power in the modern economy is no longer seized through threats. It is earned through trust, continuity, and execution. What this moment exposes is not Canadian luck or American failure in isolation. It is the danger of confusing aggression with strategy. Tariffs can punish, rhetoric can intimidate, but neither can manufacture excellence, nor can they force capital to ignore evidence. The quiet lesson from Cambridge, Ontario is brutal in its simplicity. You cannot coerce loyalty in an integrated system. You either become indispensable or you become irrelevant. Canada chose patience. Washington chose pressure. One built systems, the other burned credibility, and now the balance has shifted in ways that will outlast any single presidency. So here is the question that should ignite the comments section. If manufacturing decline was a choice, not fate, who benefited from that choice, and why are they still in charge? Because until that question is answered honestly, no amount of economic war will rebuild what was deliberately allowed to erode. And the clock is still ticking.